Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast. And today I want to start out by reminding you that there is a website associated with this podcast. It's called wealthformula.com, of course. That site has a number of resources on there, including a copy of my book, 7 Secrets of Eternal Wealth, which you can get as a PDF by simply texting me too at 44222 and typing Wealth Formula. One word, again, that it's 44222 Wealth Formula. But if you go to that site, you can also get a copy of my friend George Newberry's book, Burn Zones, which is about the ups and downs in the life of a real estate entrepreneur that he was. And by the way, George will be joining us at the Titans of Multifamily Real Estate Conference in Scottsdale. So that should be fun to have him. And for those of you who are coming to meet him in person, the event is sold out. But anyway, the other thing to recall is if you love Wealth Formula and you want to get more involved, consider joining Wealth Formula Network. Wealth Formula Network is the inner sanctum of Wealth Formula, the community, Wealth Formula Network. It's part of this course that we put out last year. And the course itself serves as a basis, the foundation on which we build. And we have a private community. We have a Facebook community. We have a private portal. And then we have bi-weekly mastermind calls, which are probably the highlight for most people, I would say. Again, you can check all that out at wealthformularoadmap.com. If you want to be part of where the magic actually happens, that is at Wealth Formula Network at wealthformularoadmap.com. Now, let's talk about today's show. Now, I'm going to say something, and it should not be taken the wrong way and as an insult, but if I hadn't listened to Peter Schiff, I would have made gobs and gobs of money, right? Now, don't get me wrong. I listen to Peter Schiff's podcast. I still listen to Peter's podcast. I think he's a really smart guy. In fact, he predicted the financial meltdown of 2008. And you hear people talk about that all the time. The problem is, or not the problem, but it would have been even more impressive if he had not predicted the financial meltdown of every other year outside of 2008, like, 1990 through 2019. But you get the point. I mean, listen, Peter has a keen sense of the economy, a very strong perspective that I respect. I listen to the guy all the time. I think the problem in general, though, is that if you only listen to Peter, like if you listen to only any one show or one very strong perspective, you might be only seeing a very narrow perspective on things. Let's take Bitcoin, for example. That's where I'm going with this in the case of Peter and me not making a bunch of money because I listened to Peter. So I started hearing about Bitcoin back in 2015 or so. And back then, Bitcoin was trading for around $250, maybe between $250 and $300. The problem is that back then I used to religiously listen to Peter's podcast, and every time he brought it up, he was so darn negative about it. He made Bitcoin sound like a big joke. And now you may not be a Bitcoin person, and that's okay. You don't need to be. But if you dig down into the concept and the economics it represents, the philosophy that Bitcoin represents, you might be thinking, why doesn't Peter Schiff actually support this? I mean, it's pretty much gold, except maybe a little bit better in theory. Anyway, he was so darn negative about it that I never bothered to take it seriously, So I didn't dig any further or try to listen to any other intelligent voices with a different perspective at that time. As a result, I lost out. Even at Bitcoin's low this year, which was like 3,100 or something, I would have still been way like 1,000% above where I would have purchased back in 15. Now, I don't blame Peter for not buying Bitcoin. I really don't. And that's why I still listen to his show. I blame myself. I blame myself for not listening to people or not trying to make an effort to listen to people with perspectives other than me. There were plenty of smart people even back then talking about Bitcoin who made a lot of sense. If you go back and you look at YouTube videos and debates, even between Peter and Eric Voorhees back in 2015, 2016, before there was a more recent one too. But Eric Voorhees has been a very intelligent voice on this topic for years. But I wasn't looking for other voices. I was too busy listening to the same podcasts. That I'm not saying they're bad podcasts. I'm just saying that when you listen to a certain set of podcasts, they're basically regurgitating what everyone else in the niche is saying. There's no one saying anything good about Bitcoin back then because everybody was listening to each other and they all said it was a big joke. So anyway, the Bitcoin opportunity loss is a larger message that resonates with me that really has to be taken to heart. So whatever your feelings about Bitcoin, the bigger point here is stop listening to the same source of information to make all of your financial decisions. You may think you're listening to a whole bunch of different podcasts, and you might be listening to a lot of different podcasts, but if the same guests keep popping up and all the time, and they're saying the same thing and they keep echoing each other, then you're basically just in a closed circulation of podcasts and that kind of, like in an echo chamber, right? So what's the point? Just listen to one and pick a good one there and then move on to something else. Now, personally, I've learned my lesson. I don't want to be part of that anymore. And that's why I'm trying to get people on the show to explain to me why I'm wrong for believing what I believe in and what I tell you what I believe in. And one of those beliefs that I've held on for many years is the idea, frankly, that I don't like commercial real estate. I don't like, generally, I don't get excited. I don't really, hop at the opportunity to invest in mini malls, office spaces, or restaurants. I am, for the most part, a multifamily guy, maybe a little bit of self-storage in there too, but I want to invest in things people have to have, not what they, want to have, places to live, place to keep their stuff, that kind of thing. So today on the podcast, you're going to hear from a commercial real estate guy who's done, quite well with it for the past 30 years or so. And he does exactly what I have said that I don't like. And he's going to make the case for all of these kinds of different commercial real estate investments, even today in 2019, which again, my personal gut tells me to stay away from. But make sure to listen to the show, especially if you tend to agree with me about stuff, because again, it is getting a different perspective. And we'll be right back with that guest. His name is Michael Flight. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Michael Flight. Michael is a real estate entrepreneur who's been active in commercial real estate over the past 34 years. Is that right? With over $500 million worth of real estate transaction. He is a partner at Concordia Realty Corporation, which he started in 1990. And since then, it has grown into a premier boutique shopping center investment redevelopment firm. Michael, welcome to Wealth Formula Podcast.
Hey, Buck, thanks for inviting me on. It's really a pleasure and an honor also. Thank you.
Appreciate that. You're over in Chicago, is that right?
That's correct. We're in the western suburbs, Oak Brook.
Got it. As you know, I fled from there fairly recently.
You were a smart man.
Yeah, I was actually there. I was in Chicago, I think it was last week, right around the polar vortex thing.
Oh, that's perfect time to visit, yes.
You had to go there because one of my businesses is there, and it was so cold. And it was like, it was like 25 degrees below zero or something like that. Does that sound about right? And that's without wind chill. right?
Yeah, and they like to exaggerate it and make it feel worse by saying, "Oh, it feels like 50 below with the wind."
Yeah,
So
yeah, yeah. There you go. There you go.
it's
Uh,
like minus 21, 25 is cold enough for me.
I was really happy to fly back to Santa Barbara, and I get off the plane, and it was like, it was in the low 60s, and felt great. And then within a day, I was like, darn, it's really cold here. When is it going to warm up? So you get really spoiled very quickly. Uh, but that's part of the joy of living somewhere warm. But anyway, listen, Michael, it was good having you on the show. Let's talk a little bit about kind of your niche in this commercial real estate. We've never done a show that really focuses on this topic, and this is why we're going to talk about it. We're talking about shopping centers, street retail, freestanding stores. And you've been doing it for a long time. Why did you choose this niche? How'd you get it started into it?
Actually, it was kind of out of laziness. I figured out when I, first became a commercial real estate broker that you could do a number of transactions with a tenant if you represented them. And in the Chicago market, if a retail tenant was expanding, they might open 10, 15, 20 stores. And so it was a lot less cold calling for me. So that's how I got into it. And then I was hired by a major syndicator out of Philadelphia. They had about, I can't remember now, but like 250 to 270 shopping centers nationwide. And then the savings and loan crisis hit, so everything kind of spiraled downwards. And instead of relocating, myself and a partner opened up a shop, and we did workouts and shopping center investment because we were both in the retail space. So
What do you mean workouts? Were you lifting weights? What do you mean workouts?
Workouts are when a bank or a insurance company or a financial institution forecloses on a property and then really doesn't know what to do with it or needs to get rid of it. So once they take it onto their books, or we would help them onboard it onto their books and then try and, pretty up as much as possible and then sell it as fast as possible so it gets off their books so that they can realize it, not a gain, but minimize their loss.
Got it. So, all right. So why, of all the different things that we can invest in, even within real estate, what's your argument or your reason for us to consider commercial real estate the way we're talking about in terms of shopping centers and street retail, freestanding stores, that kind of thing?
Well, the great thing about retail real estate is, number one, it's triple net, so that the tenants pay for the real estate taxes, tenants pay for the insurance, and the tenants pay for the maintenance of the common areas. They also maintain the interior of their store and their storefronts. So in a typical shopping center, the only thing the landlord would be maintaining is the structural components and the roof. And if it is a full triple net lease, then the tenant pays for even the maintenance of the structure and the roof. So that's a great thing because it's a lot less management intensive most of the time. So you're not like unclogging toilets and knocking on doors for rent. The other great thing is that you are doing leases with national companies. So these companies have bond ratings, so they have credit, and the leases go for longer periods of time. So on a national tenant lease, we're doing things anywhere from 5 to 10. We've actually done, with options, leases with Walgreens for up to 60 years. Mm-hmm. So when we actually have a Walgreens lease in one of our portfolios that originally started in 1957, and the lease was done before there was zip codes. So,
wow.
So that's the type of thing. And then historically, over the past few years, retail has had, better returns institutionally.
Okay.
So
let me ask you this, though, in terms of when you talk about yields, certainly I would imagine the yields are going to be different if you have a triple net with Walgreens compared to a mom and pop or some kind of just office building where they're not bond rated companies. What are you focusing on?
We are looking for value add shopping centers, although we used to do heavy value add type of things where they were almost development deals, and it's knocking down a percentage of the shopping center, or in a few cases we've actually taken malls, emptied them out, knocked them down, and built a strip center in their place. Right now what we're looking for is primarily stabilized shopping centers, or shopping centers that we know that we can add value to through leasing and management and that type of thing. But we're looking for fairly well occupied, like 80% and above, and then we can add value through leasing and through the expirations and that type of thing.
Yeah.
So
okay.
That's what we're looking at right now.
So there's, obviously when it comes to, and we talked about the soft line a little bit, when it comes to retail real estate, there are a couple of elephants in the room, so to speak, that people always talk about, at least in our sort of podcast circles, right?
Right.
Let's talk about those head on. First, one, when true or false, when the economy goes into recession, a lot of the commercial real estate that you're talking about suffers the most.
I wouldn't say it suffers the most, but I would say that the retail real estate is directly affected by consumer spending, and that. But the other thing that moderates that somewhat is, but a large majority of these leases are over a specific period of term, so that if the economy happens to go into a recession, those leases might go right through it. And so you might have some situations where you might have to reduce a tenant's rent for a little bit. But once we do that, we say, we're going to work with you, but you're going to pay us back that rent if it's a local tenant. So that's one thing. So you've got that to protect you. The other thing is that, I think that's the answer to the question. I was going to go on.
So what happened back in 2008, obviously, real estate in general was across the board was hit. How was your business affected by that?
I would say that the main thing that affected us was when we had tenant renewals. So if we had a vacancy, the vacancies weren't getting leased for probably about 2 years. And if we had a renewal, it was affecting us because the national chain stores at that point are going to say, hey, things are really not looking great. And, we're going to hammer you over the head. We're going to lock in a lower rate at that point.
Right.
So that's what it was. I could tell you, we made it through pretty well. There was certain shopping centers that did go into foreclosure, and they were just higher financed and weren't able to perform on their leasing and all the rest of that. So we were able to pick up 1 or 2 properties that way during the recession.
Sure. The other elephant is Amazon, right? Or retail is online commerce in general, and obviously it's becoming a bigger and bigger issue. You hear about a lot of the major brands that probably did have those higher bond ratings, et cetera, starting to go out of business, like Sears, for example. Can you, obviously, you've got these, you've got a lot of pressure coming from the online marketplace. Do you consider that a big risk still in terms of your business?
Well, let me address the first thing, and then we'll get to the online part. Sears, department stores, JCPenney's, they really don't have a reason to exist anymore because they've lost who their customer is. And there's, people aren't going to Sears. People aren't going to Kmart. If you take a look at tenants that are doing well, like Walmart and Target and Marshalls, in the case of Walmart and Target, they specifically revamped their stores so that they're doing online and they're doing delivery. They're doing it, whenever, wherever, however. So they both had record, sales years last year. And it's the stores that, number one, haven't really figured out what to do. And so JCPenney, I don't expect them to be around much longer. Or a lot of the bankruptcies were by retailers that were taken over by buyout firms and heavily leveraged, and then didn't have the financial wherewithal to either re-merchandise their stores and pretty up their stores, change some of their merchandise mix, or start some sort of online web presence so that they could have an omni-channel thing. So that's to kind of address what all the retail bankruptcies are. And there's a few retail bankruptcies that even have happened within the past 30 days. So, sure. But like I say, a lot of those are in markets where they're just not as competitive. And now to answer your question about Amazon realized that it just can't be a completely full online retailer. So they paid $35.5 billion for Whole Foods. And so in order to get their full omni-channel distribution, and there's a lot of online tenants, now realizing that as soon as they open up a physical store, they're actually getting a bump in sales. And it's the same situation when a physical retailer closes a store, it actually decreases their online sales. So most retailers now know that they need to have some sort of omni-channel. And there's some pretty exciting stuff. Like Kroger has Kroger has a thing where, in order to the meals, the meal plans, when you do the monthly meal plans and they deliver them right to your door. Yeah. Well, Kroger has that, but you can actually go to the store and pick up the full meal and just take it out right there. So you can order it on an app online and boom, it's out the door. Walmart is doing some really cool stuff that you can order on their app for pickup. And with geofencing, they know when you're 3 miles away, when you're 1 mile away, and when you're in the parking lot. And supposedly they have the system down so that they've gotten the stuff out to the customer within 11 seconds. So a lot of these guys are doing a lot of stuff to say, hey, we're going to just give the consumer what they want, where they want, how they want it. So, and better retailers are doing that.
So in terms of Concordia, you mentioned value add, et cetera. How can you get higher returns if you're focusing on these bigger companies? I guess that's part of what my confusion is a little bit, because I get your point. You have a Walgreens. I don't care if you've got Amazon or not. People need their corner store. They need their 7-Elevens. They need, their Dunkin' Donuts, whatever. But and those types of triple net leases, I can't imagine are providing much yield. So in a fund, how do you balance it so that you can actually get yield, or what do you do to manipulate it in terms to get the right kind of returns?
Well, actually, part of the thing that's really kind of helped with the internet and kind of trying to internet proof things is a lot of retailers used to prohibit restaurants, and they used to prohibit other types of uses in the shopping center. And they realized it's like, okay, so if we exclude all these other uses, then we're going to have a vacant shopping center. We don't want that. And so they want people coming to the shopping center. So we've been able to replace a lot of those, or some of those tenants, with restaurants. And restaurants do higher volumes and usually pay higher rents. And so that's good. And then it brings people to the shopping center. And typically, if people come to the shopping center to eat, they also might purchase something, or they'll at least stay in the shopping center longer. And so you have a higher chance of getting them to purchase something. And then we get some better rents with medical use because you've got a little bit more capital up front in terms of building out the medical space, but you've got higher rents because that tenant improvement is capitalized over the life of the lease, and you get some, a doctor's group or a hospital group guaranteeing, the lease.
So it sounds like you're kind of pretty broad in terms of the fund. You're doing everything from restaurants to, Walgreens to medical offices. Is that right?
Yeah, well, we do that. We don't necessarily do, a bunch of single tenant deals. We primarily buy shopping centers, and where we get into single tenant deals is if we've got either a vacant out parcel, which is the restaurant or the Walgreens out in the front of the shopping center. That's where we'll get into, maybe a change of use or a single tenant lease. And then the other way we add value or return capital faster is a lot of times we look for shopping centers that have a out parcels, like with a like a McDonald's or a Jack in the Box or something like that, or even a Walgreens. And so you can buy the shopping center, let's say at an 7, 8, or 9 cap, and you can sell a Walgreens at a 5 cap or a 6 cap.
Meaning the Walgreens is part of the shopping center already? Is that
right? So you're buying the entire parcel wholesale, and then you're splitting it up and selling it off retail.
Got it. Like sort of office condominiums or that kind
exactly.
of thing. Exactly. Right. Understood. Well, interesting. So, where are you buying right now? There's specific markets that for this kind of, this kind of niche real estate is better than others?
I will tell you, since we brought it up, I am not buying anything in Illinois right now. The real estate tax issues here are crazy.
Yeah, they are.
We really like Indiana, which is right next to us. We think that there's some really good growth in Wisconsin and Michigan also are doing fairly well. And we have partners in Texas, Tennessee, Phoenix, Arizona, and we really like Nevada. So we're still playing with a deal that we're trying to make work up in Reno, because Reno is just exploding right now with population. Tesla, Apple just bought like 1,000 acres there, and I believe Google bought 1,500 acres there. And then there's a few drone companies out there. So Reno, we think, is going to be the next Austin.
Got it. So are you concerned at all right now? Like, how are you positioning yourself, or are you doing anything differently now than you were doing, say, back in 2012? Everybody says the economy is really hot and, some level of recessionary activity is inevitable, et cetera. Maybe it won't be the zombie apocalypse, but maybe there'll be some level of softening. Are you guys doing anything different right now to try to mitigate that risk?
We're being much more comfortable. Since we started out basically in a major recession in 1990, and we've been through, 3 full cycles. We've seen it come and we've seen it go. And we're just being extremely cautious, but at the same time, we can see a lot of opportunity. And the great thing about people talking about the collapse and the apocalypse of retail is that there's been a little bit of a dislocation in the market, especially for some of the properties that we look for that might be a higher cap rate and a little bit out of favor. And then the other thing is that publicly traded REITs have really been punished lately because of that. And so they've been unloading a lot of property too. So it's actually created a pretty good buying opportunity. And, we're just making sure that we follow, what our acquisition criteria is, and we don't get too crazy about hey, this is a really great looking center and we really want to be here. It's like, does it really make sense? And so I have this discussion probably every other day with our acquisition guys, because it's like, I want to pull the trigger. I want to pull the trigger. It's like, I know you do.
Be careful, right? Yeah. Fantastic. Well, listen, Michael, where can we learn more about, your business and, what you're up to?
They can go to our website. It's concordiarealty.com. That's CONCORDIAREALTY.com.
We'll put something in the show notes there too. I want to thank you very much for being on the show. I know we were talking earlier. It's an area that I have not explored much, but I want to make sure that for people who have an interest in investing in this kind of real estate, that they had some information. So I appreciate, again, being on Wealth Formula Podcast today.
Thank you very much. And I've signed up, and I'm looking forward to seeing you in Scottsdale.
Oh, good. Yeah, we are sold out. Yeah, that's good news. I'll see you there, and I guess other people will get a chance to meet you there as well.
Thank you.
We'll be right back. Well, welcome back to the show, everyone. So what do you think after that show? Are you now a commercial real estate person? Maybe you were before, and maybe that just reinforced it. Well, personally, I am probably somewhat more open, again, to the idea of, triple net, AAA rated long-term leases like Walgreens. The problem is with those kinds of things, the yield is not great. So I think that would be a challenge for me. I might also be interested in medical, but I don't know if I'm convinced of much more than that. I will say that I think that Michael's a pretty thoughtful, smart guy, and it seems like he's seen cycles high and low and is pretty good at hedging his purchases. So he's been through, the worst of the worst, and he's got some scar tissue. And again, that's the kind of person you want to look for when you're looking in a potential different asset class. So you may want to talk to him. That said, I think I'll probably largely myself continue to focus largely on multifamily. Speaking of multifamily, Mike will be at our Scottsdale event as well, so you can meet him in person. Our Scottsdale event, of course, is called the Titans of Multifamily Real Estate. Mostly it's on March 2nd, although we'll be meeting up informally on March 1st as well. I would tell you where to go buy tickets, but it is sold out. If you really, really, really want to come, shoot me an email, and if somebody drops off, I'll get you in. That happened last week, actually. So somebody canceled, and we were able to squeeze somebody else in. So it does happen. Let me know. But, it's a small event, 100 people. It was meant to be that way so that we could have sort of more of a meetup, sort of small networking, not networking, but, not like we're trying to do, business with each other. It's just a way to get to know each other. It's hard to do that when there's like 1,000 people there. Anyway, so that was done on purpose, a small sort of event where everybody gets to get a chance to get to know one another. I get the chance to hopefully meet every single one of you. So I look forward to meeting you all there. Now, that said, I know that, again, next time we will probably choose a bigger event, a bigger venue, etc. And maybe we'll do it in Dallas or somewhere more central so the East Coast people don't get left out. In the meantime, don't forget that if you do want more Wealth Formula, there's nothing easier than to simply go to wealthformularoadmap.com and join our Wealth Formula network. And start getting involved with our course and our calls and our Facebook group, etc. Anyway, that is it for me this week. This is Buck Joffrey signing off.